I want you to stop whatever you are doing right now and think carefully about something that happened last month that almost no mainstream financial media took seriously enough to explain. The UAE, one of the most strategically positioned and economically powerful nations in the entire Middle East, quietly walked out of OPEC, not temporarily, not as a negotiating tactic, permanently. And within days of that announcement, the UAE Central Bank made a statement that if you understand how the global monetary system actually works at its deepest mechanical level, should have stopped you cold. They said they were considering pricing their oil in currencies other than the US dollar. I have spent the last 40 years studying how economies, debt cycles, and empires rise and fall. I have watched monetary systems shift from the inside, and I want to tell you plainly, without drama, without exaggeration, that what is unfolding right now in the global oil market is not a geopolitical headline. It is a structural fracture in the architecture of American financial power that has been holding the world together since 1974. And most people, including most serious investors I speak with, do not yet fully grasp what is mechanically happening beneath the surface, or what it means for where wealth will be preserved and where it will be destroyed in the decade ahead. To understand why this moment is genuinely historic and not merely dramatic, you have to go back to the foundation. You have to understand what the petrodollar system actually is, how it was built, and why it has been the single most powerful invisible force in global finance for the past 50 years. In 1944, the world gathered at Bretton Woods in New Hampshire and agreed that the US dollar would be the anchor of the global monetary system, backed by gold at a fixed rate of $35 per ounce. Every other currency was pegged to the dollar. The dollar was pegged to gold. It was an elegant architecture, and for roughly 25 years it worked. It financed the post-war boom. It rebuilt Europe and Japan. It created the conditions for the greatest expansion of human prosperity in recorded history. But by the late 1960s, the United States was spending heavily on Vietnam and on Lyndon Johnson's Great Society domestic programs simultaneously. Fiscal deficits were mounting. France, led by Charles de Gaulle, who understood economics better than most American politicians of that era, began demanding that the United States honor its gold obligations. He sent French warships to New York Harbor to physically bring gold back to Paris. Other nations followed. The gold at Fort Knox was draining, and in August of 1971, Richard Nixon went on national television and did something that most Americans at the time did not fully understand. He closed the gold window. He ended dollar convertibility. He broke the promise that the United States had made to the world in 1944. The Bretton Woods system was over. Now here is the critical thing that most history books skip over, because what happened next is the part that actually explains the world we live in today. When Nixon closed the gold window, the dollar lost its anchor, and without an anchor, there was no structural reason for the rest of the world to hold dollars, to trade in dollars, or to denominate their contracts in dollars. The exorbitant privilege, the ability of America to print money and have the world absorb it, was suddenly in question. This is where Henry Kissinger enters the story, and this is where the deal that shaped the next 50 years was made. In 1974, Kissinger flew to Saudi Arabia and negotiated what was, in effect, the most consequential financial agreement of the 20th century, and it was never written down as a formal treaty. It was a handshake, an informal arrangement between two governments that understood their mutual interests perfectly. The deal had 3 parts, and you need to understand all 3 because all 3 are now fracturing simultaneously. Saudi Arabia and the Gulf producers would price and sell their oil exclusively in US dollars. Every nation on earth that needed oil, which was every nation on earth, would therefore need to acquire dollars first. This created a permanent, structural, non-negotiable global demand for the dollar that had nothing to do with American interest rates nothing to do with American economic performance, and nothing to do with the attractiveness of American financial markets. The demand existed because energy existed, and energy required dollars. The second part of the deal was that the petrodollar revenues the Gulf states accumulated would be recycled back into U.S. Treasury bonds. The dollars earned from selling oil to Japan, to Germany, to South Korea, to India, would flow back to Washington as loans to the American government. This kept U.S. borrowing costs artificially low. It created a permanent structural buyer for American debt that allowed Washington to run fiscal deficits that no other government in the world could have sustained without triggering a currency crisis. The third part was the American guarantee: military protection, weapon systems, political cover, a permanent U.S. security presence in the Persian Gulf. You price oil in our currency and buy our debt. We protect your governments, your oil fields, and your thrones. That was the deal, and for 50 years it held. The implications of this arrangement for American economic power cannot be overstated. Because of the petrodollar, the United States could import goods from the rest of the world in exchange for dollars that cost nothing to print. Because of the petrodollar recycling mechanism, the U.S. government could borrow at interest rates far below what its fiscal position would otherwise justify. Because of the structural global demand for dollars, the Federal Reserve could expand the money supply in ways that would have been catastrophically inflationary for any other country. Economists call this the exorbitant privilege. I prefer to call it what it actually is. It is a 50-year subsidy that the rest of the world has been paying to the United States in exchange for the stability that American military and monetary dominance provided. The world accepted this arrangement because the alternative, a fragmented monetary system with no dominant anchor, seemed worse. And for most of the post-war period, that calculus held. American institutions were trusted. American courts were independent. American monetary policy, while imperfect, was not weaponized as an instrument of geopolitical coercion. That trust was the invisible asset that made the whole system work. And that trust is now eroding in ways that are structural rather than cyclical, ways that I do not believe will reverse. Now I want to walk you through precisely what is fracturing today, because the current situation is not one crack, it is three simultaneous fractures in three different pillars of the same structure, and the timing of their convergence is what makes this moment historically significant. The first fracture is the UAE's departure from OPEC, and to understand why it matters beyond the headline, you need to understand the UAE's specific economic position. The UAE has invested massively over the past decade in building oil production capacity. Their infrastructure is capable of producing 5 million barrels per day. OPEC's quota system constrained them to somewhere between 3 and 3.5 million barrels. Imagine building a factory with the capacity to produce 5 million units annually, and then being told by your business partners that you are only permitted to operate it at 60% of capacity. For years, the UAE absorbed this constraint because the broader OPEC framework provided pricing stability that partially offset the production losses. But the calculus changed when the UAE joined BRICS in 2024, because BRICS is not simply a trading bloc, it is at its structural core an alternative financial architecture designed to reduce the dependency of its member nations on the dollar-centric system. And once the UAE was inside BRICS, the logic of pricing its largest customer's oil in its largest customer's currency became commercially and geopolitically coherent in a way it had not been before. China is the UAE's single largest oil buyer. The commercial case for pricing those transactions in renminbi rather than dollars is not ideological. It is rational. It eliminates currency conversion costs. It reduces exposure to dollar volatility. It deepens the financial relationship with the world's largest manufacturing economy. The UAE Central Bank's statement about potentially shifting to non-dollar pricing is the public acknowledgement of a commercial logic that has been building for years. The second fracture is more serious because it strikes at the original source of the petrodollar's power. Saudi Arabia, the country whose cooperation with Kissinger in 1974 created this entire system, is in active structured negotiations with China for long-term oil supply contracts denominated in renminbi. I want to be precise about what these negotiations represent, because imprecision here leads to miscalculation. These are not preliminary exploratory discussions. These are structured negotiations for agreements with 10 to 20-year time horizons. If they conclude successfully, the foundational premise of the petrodollar, that oil is universally priced and settled in dollars, will have been broken at the source. And Saudi Arabia's willingness to engage in these negotiations is itself the signal, regardless of whether the contracts are ultimately signed, because it tells you that the kingdom no longer views the petrodollar arrangement as non-negotiable. It tells you that the relationship calculus Kissinger established in 1974 has shifted enough that Riyadh is openly exploring alternatives. Consider what has changed from Saudi Arabia's perspective. The United States is producing more of its own oil than at any point in its history. American dependence on Gulf oil imports has declined significantly. The security guarantee that was the American side of the 1974 bargain is worth less in an environment where Washington's strategic attention has rotated toward the Pacific and where its own domestic political environment makes sustained foreign military commitments increasingly complicated. The deal that made sense in 1974, when America needed Saudi oil and Saudi Arabia, needed American military protection in a region surrounded by hostile states, makes less obvious sense in 2025 when both sides of that equation have shifted. The third fracture involves what I consider the most underappreciated mechanism in global finance, the treasury recycling system. The petrodollar created not just demand for dollars, but a specific pattern of where those dollars went. They went into U.S. Treasury bonds. They financed American government borrowing at below market rates. And the steady erosion of that demand is now visible in the data in a way that should concern anyone who understands the arithmetic of American government finance. China's holdings of U.S. Treasury bonds have fallen by approximately 50% from their peak. China was once the largest foreign holder of American government debt. That reduction has been deliberate, sustained, and accelerating. It is not a reaction to any single event. It is the expression of a long-term strategic decision to reduce exposure to assets that can be frozen by American executive order. And here I need to address the event that I believe fundamentally changed the global monetary calculus in a way that will reverberate for decades. In February of 2022, the United States and its allies froze approximately $300 billion of Russian central bank reserves. I want you to think carefully about what that action meant, not from an American policy perspective, where it had a certain logic as a response to the invasion of Ukraine, but from the perspective of every other central bank on the planet that held reserves in dollar-denominated assets. What the Russian episode demonstrated with perfect clarity is that dollar reserves are not unconditionally yours. They are yours as long as your government's relationship with Washington remains within acceptable parameters. The moment that relationship deteriorates beyond a certain threshold, those reserves can be made to disappear with a digital instruction. Every Treasury Ministry and central bank on Earth conducted the same risk assessment in the weeks following that decision. The question was not whether Russia deserved the response. The question was whether their own reserves were subject to the same conditional ownership. And the rational answer to that question is yes. Under the right circumstances, they are. The asset migration that has followed from that realization is the most important capital flow story of the current decade, and it is the direct mechanical link between everything I have described and gold structural behavior. The central banks that are reducing their dollar exposure are not moving into euros. They are not moving into yen, They are not moving into renminbi. Those are fiat currencies issued by governments that can be sanctioned, pressured, or destabilized. The asset they are moving into at a pace and scale that has not been seen since the immediate post-Bretton Woods period is gold. Central banks globally purchased over 1,000 tons of gold in the most recent year, for which complete data is available. Poland, Kazakhstan, India, Singapore, Brazil, Uzbekistan, nations across vastly different political systems, economic models, and geopolitical alignments, all arriving at the same allocation decision. This convergence is not coincidental. It is the rational response of institutions with the most comprehensive understanding of monetary system risk to the demonstrated conditional nature of dollar-denominated reserves. Physical gold held in domestic vaults answers the question of counterparty risk differently than any other reserve asset. It cannot be frozen by a foreign government's executive order. It cannot be sanctioned. It has no nationality. It has no issuer. It cannot default. And critically, it has functioned as a store of value across every monetary system that human civilization has built and subsequently destroyed for 5,000 years. The Roman Empire debased its currency. The Ming Dynasty's paper money collapsed. The continental dollar became worthless. Gold survived all of them. Not because gold is magic, because gold is scarce, durable, and not controlled by any government. Now I want to address something that I think most retail investors are fundamentally misunderstanding about gold's recent price behavior, because the confusion about why gold moved the way it did during recent geopolitical events reveals a deeper misunderstanding of what gold actually responds to mechanically. The common belief is that gold rises on fear. This is one of the most repeated and least accurate statements in financial commentary. Gold does not primarily respond to fear. Gold responds to real yields, to the direction of the dollar, and to liquidity conditions in the global financial system. During the acute phase of any geopolitical crisis, there are forces that temporarily suppress gold, even as the fear environment suggests it should rally. The dollar strengthens as global capital seeks the most liquid safe haven. Real yields rise as central banks are constrained from easing by inflation concerns, and leveraged investors who hold gold futures and leveraged ETF positions face margin calls and are forced to liquidate the very asset that looks most attractive on a fundamental basis. This mechanical suppression is temporary by definition. It ends when the leverage clears, and when it clears, gold reverts to reflecting the structural forces driving its long-term demand, which are the forces I have been describing throughout this analysis. I want to name the three structural forces supporting gold with precision, because understanding them individually and as a system is the foundation of any coherent thinking about positioning in the current environment. The first is de-dollarization, not the dramatic overnight collapse version that gets attention in sensationalist financial media. The slow, measured, rational country by country reduction of dependence on the dollar as the primary medium of international trade and reserve storage. The UAE's OPEC departure and non-dollar pricing consideration, Saudi Arabia's renminbi negotiations, India's rupee-denominated oil payments, China's treasury reduction, the Bryce alternative payment infrastructure. These are not isolated events. They are individual rational decisions that collectively constitute a directional shift in the architecture of global finance. The direction is not in question. The pace is slower than the headlines suggest. But the vector is clear, and it is not reversing. The second structural force is debasement. The United States has added approximately $2 trillion to its national debt in a single year. The interest payments on that accumulated debt now rival the entire defense budget as a line item in the federal budget. The only politically viable resolution to this arithmetic involves some combination of inflation, financial repression, and monetary accommodation that gradually reduces the real value of the debt burden. This is not a prediction. It is the pattern that every major sovereign debt cycle in history has followed when debt levels reach the ratios the United States is currently approaching. Gold cannot be debased by policy decision. Its supply grows by roughly 1 to 2% annually through mining. No central bank meeting can change that rate. In an environment where the dominant reserve currency faces structural debasement pressure, gold scarcity is not a historical curiosity. It is a current competitive advantage. The third structural force is diversification, the rational portfolio management response to a world of accelerating geopolitical fragmentation. Supply chains are restructuring along geopolitical lines. Trade relationships that were stable for decades are being renegotiated under pressure. European nations are rearming at a pace not seen since the Cold War. Asian security architectures are shifting. In this environment, concentration in assets whose value depends on the stability of any single geopolitical relationship carries risks that simply did not exist in the same form a decade ago. Gold provides the only form of diversification that is genuinely independent of these political relationships and the financial architecture they underpin. Let me now be direct about where this leaves the practical investment question, because I believe in being as precise about the actionable dimension as about the analytical one. Physical gold and unleveraged exposure through well-structured ETFs represents the foundational position for investors who want direct exposure to the de-dollarization and debasement thesis. It does not generate cash flow. It does not compound in the way that equity ownership in productive enterprises compounds, but it has preserved real purchasing power across monetary system transitions in a way that no fiat currency in human history has been able to match over long time horizons. The comparison that I find most clarifying is this one. An ounce of gold purchased a high-quality Roman toga 2,000 years ago. An ounce of gold today purchases a high-quality suit. The dollar that was worth 100 cents in terms of purchasing power in 1971 is worth approximately 7 cents of that original purchasing power today. The monetary system changed. The gold held its value. That pattern has repeated across every major monetary transition in recorded history. For investors who want leveraged exposure to the same thesis with a different risk profile, gold mining companies provide operating leverage to the gold price that can be significant during sustained gold bull markets. A miner's revenue moves directly with the gold price. Its costs, labor, energy, equipment, and capital expenditure are largely fixed in the near term. When gold rises 25%, a well-run miner's operating profit can increase 30 to 50% depending on its specific cost structure. This operating leverage is the reason miners historically outperform bullion during extended gold bull markets. The current structural environment, where gold's tailwinds are as strong as they have been at any point since the 1970s, is precisely the environment where that leverage becomes most valuable. But I want to close with the observation that I believe is the most important thing I can leave you with from this entire analysis. Not the specific investment implication, not the price targets, not the technical levels. The most important thing is the historical pattern that the current situation most closely resembles and what that pattern tells us about timing and positioning. The petrodollar system did not fail overnight. It did not fail with a single dramatic moment that everyone recognized in real time as the turning point. The conditions that produced the Nixon shock of 1971 had been building for years before the shock itself. France had been demanding gold redemption since the mid-1960s. The gold outflows from the Federal Reserve had been measurable and accelerating for years. The fiscal pressures of Vietnam and the Great Society programs were fully visible to any serious analyst. The people who understood what those accumulating pressures meant, who held gold at $35 per ounce when the consensus view was that gold was a relic and the dollar was unassailable, and who maintained that position through the criticism and volatility that accompanied it, captured one of the greatest wealth preservation trades of the 20th century as gold moved from $35 to $850 over the following decade. They were not rewarded for being dramatic or alarmist. They were not rewarded for predicting exactly when the shock would come or what form it would take. They were rewarded for understanding the structural forces before those forces became obvious in prices. The fractures I have described today, the UAE's departure from OPEC, Saudi Arabia's renminbi negotiations, China's treasury reductions, the accelerating central bank accumulation of physical gold, these are the accumulating pressures of the current cycle. The shock that crystallizes them into a visible, undeniable systemic transition may not come this year. It may take several more years. Systemic transitions of this magnitude move on decade, long timescales, not quarterly earnings cycles. But the direction of the structural forces is not ambiguous. The pace of change is accelerating, and the capital flows responding to these forces are measurable and documented in the data I have cited. The petrodollar is not dead today. The dollar is not going to zero. The United States financial system, despite its fiscal trajectory and the fractures I have described, remains the deepest, most liquid, and most institutionally sophisticated financial system in the world. That is not going to change quickly. But the unchallenged monopoly, the world in which every barrel of oil requires $1, in which every oil producer automatically recycles revenues into treasury bonds, in which American fiscal excess is permanently subsidized by the rest of the world's structural dollar demand, that world is ending. Not with a crash, with a slow structural unwinding that will be obvious in hindsight, and that is visible right now to anyone who is willing to look at the data clearly and follow the logic where it leads. Gold understands this. The central banks accumulating it at historic rates understand this. The question I leave you with is not whether this transition is happening. The data makes that question already answered. The question is whether you will understand it before the translation becomes obvious to everyone else. Because by the time it is obvious to everyone else, the positioning opportunity will already be gone. That is how these transitions always work. And that is exactly what the data is telling us right now.